of different views about whether we should be sitting on the sidelines right now or entering the markets. Some say we still have to wait for those lows to re-emerge. What is your investment philosophy right now?
Look, I mean, if you were invested in the equity market the last 5 years, you've probably made about 22% per annum. I mean, those are great returns. I mean, if you look historically at returns on the all share, and you look historically at returns right across the globe, to make 22% per annum is a really, really good return. And I mean, I'm including now the meltdown that we've had in 2008. I'm including most of the bad numbers that we've seen. So, equities continue to be the place to be. To put it bluntly, if you want to make money, you've got to be in equities. And despite that, despite the long-term numbers, and despite the fact that the market's probably up, year to date, probably 19%, people continue to fence it. People continue to sit on and say, will this thing go lower? Will it go higher? Will it go lower? Will it go higher? I mean, with those kind of numbers, why would you want to fence it? Why is it that people would like to sit on the fence and say, I don't actually want to be in this asset class, because every day it's just becoming more and more expensive to do business in the equity markets.
I completely agree with that. But what is interesting to note is the earnings still remain relatively subdued, and a certain amount has been priced into the markets right now. We've seen share prices rallying quite significantly. Are you not concerned that the earnings could disappoint going forward from here, and this will directly weigh onto the share prices?
Look, economic data and earnings work together, right? So most economic indicators tell you about the past. They tell you about the situation that you've just lived through. And earnings is exactly the same. Earnings show you the past and show you what you've lived through. Now, and the forecast is all about trying to extrapolate what you're living through right now and saying could it potentially look like going forward. Now, earnings can turn very, very quickly. Already we're seeing a bottoming out effect as far as economic data is concerned. And yes, the bottoming out effect could take far longer than what most people are anticipating. And the earnings, quite rightly then, could also take far longer to come through. But if earnings come through next year, or they come through the next year, you're still buying a cheap market today. I think the big thing that makes people fearful about equities is the fact that they can actually lose money in markets. So, so markets can lose 25-30%, and that obviously isn't nice to live through. But when you're buying a value-based market, hence a market which is already cheap, which we're sitting through, as you know, already here in South Africa and across the globe, then usually the fall that you have to take from these levels is probably far less than the fall that you have to take from a market which is very, very expensive.
Now, you mentioned forecasts, which is quite a key thing. With all the earnings that we've seen coming through, most forecasts say there are tough times that lie ahead. How do you respond to that?
Do you know how many times forecasters get it wrong? Get it wrong all the time. They get it wrong probably about 80 or 90% of the time.
Companies themselves are saying that earnings will remain subdued, and we don't really know. Tough times lie ahead. Even the likes of ShopRite saying tough times lie ahead. Bidvest, the same theme coming through from there, and notwithstanding the banking sector as well.
Look, if you look out for the next 6 months, yes, things aren't all of a sudden going to be turning around in the next 6 months. All of a sudden, you're not going to have a condition in the markets which all of a sudden you're just going to have a ton of new clients, coming through your doors, pushing up your earnings. Yes, that's quite correct. In the next 6 months, things will probably continue to be tough. But what about next year? What about the second half of next year? What about going into 2011? What does that look like? What does the impact of 2010 look like in this economy? All those things are being discounted at this stage. People don't really understand and really know what the impact of those things are going to be. And that's why if you're able to buy stock from a value-based perspective, hence you've done your valuation on the business, you understand what it's actually worth, and you're buying at a discount to that. If you're able to do that, you can hold long term. Because you don't know what these ulterior factors are. And it's not really about the next 6 months. It really is about a year and 2 years and 3 years from now. How are you buying those earnings?
25,000, that's where we are right now, approximately on the JSE All Share. We hit a high of about 33,000 last year, March. Do you expect markets to reach those levels once again and sustain those levels?
Look at price to earnings ratios rather. So look at price relative to earnings. Earnings are depressed, so earnings are probably down about 12-13%. For the year so far. 2008, we've actually seen earnings rise on average, because again, it's a retrospective number. It's not a number looking forward. So if you look at the price to earnings ratio for the market at the moment, it's still below its long-term averages, and we're working off a depressed earnings number. So once the earnings number changes, the price to earnings ratios, if price doesn't revert, continue to then drop and drop and drop. So we're still below averages as far as price to earnings ratios are concerned, which continue to indicate that we're in a value-based market. I think the thing that concerns a lot of people is, do you take 100% of your money and just chuck it into equities? I mean, do you just kind of blindly do that? And I don't think this is just a blind a blind type exercise where you just throw your money into the market and you say, c'est la vie, what will be, will be. I think the more important thing is look at diversification across, a couple of asset classes. If you're scared about equities, if you don't want to go into other asset classes, look at putting money into equities, but keep a cash reserve. Because if the market all of a sudden decides on a company that, oh shucks, look, earnings are going to only move out maybe another 6 or 12 months, the market will generally sell that company down and you're able to buy that business off a lower level. Then that becomes, obviously, to come to fruition. Most people in the street don't know how to do this, and that's why there's financial planners out there, which will help them through this exercise.
Right, obviously you should have money in various asset classes as you've alluded to, but just taking a look at the equity markets right now, should you be putting your money into specific companies or rather looking at the sector or maybe even the Aussie 40?
Look, the market as a whole is cheap. So if you look at the Aussie, across the board, it continues to be cheap. Yes, there's sectors which are slightly more pricey than other sectors and so on, but on average, the market is cheap. I always say, invest in what you know. Invest in what you understand. So, if somebody comes around, you're playing golf with somebody on a Saturday and somebody says to you, here's a hot tip, invest in XYZ company. That's generally not a great idea. Understand what you're investing in and understand the reasons why you're buying those businesses. And there's a whole bunch of methodologies you could be following to do that. And again, if you don't know how to do that, go get some help.